Hey, it's Adamesh. One of the questions I often get asked is, what made you switch from trading stocks most of the time to trading options most of the time? So I wanted to answer that today. And the simplest answer is really just that it made sense. The math made sense. And let me take you through what I saw and why trading options for me became a no-brainer. Let's take a look at Apple as an example. It's currently trading at 187.32 by 187.33. Price is moving, market hours. So if we wanted to buy 1,000 shares of Apple at 187.32, our max loss would be $187,300. That's how much we would have to put up to trade 1,000 shares of Apple. Now, if we wanted to trade the options and we thought it was going to go up, if you think it's going to go up, you're going to buy a call. If you think it's going to go down, you're going to buy a put. So in this case, we think it's going to go up. So the May 25th options, which is 4 days away, are trading at 116 by 118. And so you're only paying a little bit of premium, and that's the amount above where it's currently trading to get into the stock. So if we were owning it even, we'd be paying 187.31. The $1.20 above the 187.50 means we're paying $1.40 in premium right now. 20 cents to get to 187.50, then another $1.20. But the thing is, as you'll see, because this is moving, as this stock moves up, the option price is going to go up anyhow. So it essentially trades like a stock anyhow. It's a synthetic stock, because the less time you have, the more the option is going to just trade like a stock. But now watch what happens if we try to trade the option. If we buy the 187.50, 10 contracts, instead of needing $187,000, we need $1,200. Okay? Now here's the best part. If all of a sudden Apple comes out with some kind of news or whatever it is, and the next thing you know, it opens tomorrow, it's at 200. Look at the difference. If you had bought $187,000 worth of stock and it went to 200, you would have made $12,500 profit. Divided by 187,500, you would have made 6% on your money. But as an options trade, if it went up $12.50 off the 120 you bought it for, it'd be 1130 divided by 120 is 941%. That's options versus stocks. You just went from a 6% win to over a 900% win. Also, if something bad were to have happened to Apple and it went down to 150, whereas in the stock you would have lost $37,000, in the option, your max loss is always going to be the price you paid for the call, which in this case was $1.20. So after you play with those numbers in your head and you know you're going to get paid if the option goes up, but your risk is defined if it goes down, how do we not trade options? Right? Now there's so many more tricks I'm going to show you along the way to other things that options have. But right now, at the end of the day, the most important thing is don't even worry about what I'm saying. Look what I'm doing. This is a stock trade. Up nicely today. This is an options trade, 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 options, 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 stock, stock. So most of the moves I'm making right now involve options. The math makes sense. Your risk is defined. You need less money to do it. And using a call option is a great way to own a stock without all the risk that comes with the owning a stock. So why did I switch from stocks to options? There you have it. The math.